Hello, everyone. Welcome to our exclusive client webinar hosted by our Fidelity Digital Assets Research team. I'm Chris Kuiper, Director of Research, and I'm joined once again by my colleague, Jack Neureuter. As a reminder, or for those of you who are new, this is our time to recap industry news, offer our insights, and most importantly, answer questions from you, our valued clients. So we will allocate time at the end for questions, so do please populate them in the Q&A box via Zoom. Just click on the Q&A button. And as a note, these questions will be submitted anonymously. Also, just another housekeeping note, we are recording this session, but it will not be distributed beyond our exclusive clients. All right, so let me pull up our slides here. We, of course, have another exciting webinar. It's never a dull moment in the crypto world, as usual, Jack. So just a brief overview of what we're going to be looking at. If you read our last newsletter, our monthly newsletter, we took a little bit of a different tact where instead of going through our regular cadence of data and recapping news, we did a whole retrospective review on 2021 and not just recapping those events, but then looking at them with an eye towards 2022 and beyond. What do these big milestones mean for Bitcoin, for the digital asset ecosystem? So we are going to get to that, but I think what's on everyone's mind is a little more of the near-term Bitcoin price action. We'll take a look at some of the metrics we're watching as well as other data. Jack, I know you have some updates on derivatives as well, so we'll get to that. First of all, let's just talk about the past year's price action just to kind of set the stage. So this is over the past year. We do put these slides together a few days in advance, so we don't have today's or the last couple days of the move down to about 40,000 now. So rather than 35% down from the all-time high, we're about 40%. But again, just stepping back, 2021, we notched a little over a 40% gain. So if you were allocating a portion of your portfolio to Bitcoin and you looked at your statement at the end of the year, hey, Bitcoin's up 60, 65%, best performing asset class of the year once again. However, it just doesn't feel like that, right? I mean, we started out of the year extremely strong out of the gate, doubling in just a few short months. Then we had to endure this painful 50% correction. A lot of that triggered or set off by China's mining ban, which we'll talk about. And then we worked our way back up to yet another new all-time high. So first a new all-time high in April or May, and then another one at the beginning of November with the big inflation print numbers. And now we're again down 40%. So Jack, what can you tell us about what's going on here? This chart looks like one big consolidating kind of price move, but it just doesn't feel that way.
Yeah, I feel like if you risk adjust Bitcoin's returns last year, right, using risk as volatility probably wasn't Bitcoin's greatest year, just because there was so much volatility along the way. And so you noted, did we end the year up? Well, yes, technically we did, right? We started the year at 30,000 and now today we're at 40,000. So the past 12 months, that's up 30+%. But along the way, and keeping in mind also that there might be people that just because the price at the start of last year was 30,000, maybe they didn't own Bitcoin at the start of last year, right? And so reassuring that the fundamentals in the long-term picture is still there, I think is really important. And I mean, that's something that we'll do here today. And we continue to see sort of Bitcoin, especially over the last month or two, sort of tightly wound to what's going on in macro. More and more as traditional investors get involved. And that's always been, sort of a characteristic of this asset is risk on, risk off. Well, Bitcoin will, do well in risk on environments because there's a supply cap and a growing network effect. And then when there's those risk off events, it's not a panacea. It's not a cure all for a portfolio. It will still, there's a lot of leverage on top of Bitcoin, like we talked about last time, and Bitcoin's susceptible to sell-offs like this for sure.
Yeah. So we didn't create a separate macro slide this time, but let's talk about that a little bit since you mentioned it. For those who aren't, as big of Fed watchers as you or I are, or aren't in the weeds, last week we saw the Fed release its minutes. And it was really surprising to me because I thought this was pretty well telegraphed that they're going to start winding down the bond purchases. That clears the way for more rate increases. If you look at the futures markets, the markets were pricing in more rate increases, but I guess it just didn't sink in yet with the rest of the consensus or the market narrative, because all of a sudden the minutes, hit everyone over the side of the head saying like, get ready for rate increases here. It was clearly telegraphed. Jim Bianco, one that follows this closely, I love his commentaries because he's always backing it up with a lot of data. So I saw he put out a note that said, last week was the worst week for the 30-year bond in at least its 49-year history. So the 30-year lost over 9%. And for those of you who aren't in the bond market, that is a massive 1 week move. I mean, that ranks up there with, the week Lehman Brothers failed, or we had the repo market blow up, or some of these big events. So the 10-year did a similar kind of move, huge move down. And so why is this happening? Well, I think people are realizing, the punch bowl's getting taken away by the Fed. The party's over. It's they don't want to be stuck way out on the long end of the curve here. Anything else you have to add there on the macro side, Jack?
Yeah, I think Urian refers to that. So Urian Timmer, right, like sort of leading macro thinker out of Fidelity, refers to it as the dance. Like the Fed and thinking of monetary, while at the same time you have policymakers deciding on fiscal policy spending, and there's sort of this art or this dance that's happening between some give and take from each side, and sort of watch markets, watch unemployment, watch inflation, and there's sort of different moving parts, and there's this whole sort of dance going on, and we're seeing sort of hawkish sentiment out of the central bank. And what does that say to markets? Well, it says, sort of, if Bitcoin has done well because of added liquidity into the system over the past, 2 years, well, then pulling liquidity away from the system, or at least talking about pulling liquidity away from the system, will probably, at least over the short term, right, create some headwinds. But I think that if we look at sort of just U.S. fiscal situation, we know that things can't get too tight, right? And so you have midterms the end of this year. And my understanding is that there will be sort of some power shifts such that spending will be a little bit more difficult, right? And if that occurs, right, now all of a sudden you get fiscal tightening. Well, how tight can central banks make things? How much tapering can they do, and how much talking can they do if fiscal is stepping away and now that monetary side starts to step away? You might tighten too much. So I think that maybe there's a little bit of an overreaction going on here, but we'll see, right?
Yeah. So it's clear, they want to build up this credibility in the face of this inflation. We're going to get the latest number on Wednesday. The expectation I saw is for 7%, up from last month's 6.8 year-over-year percent in CPI rises. So we'll see, if this is going to be enough to tamper down those expectations or not. And if they do build up that credibility. But like you said, this is, maybe a little bit more our opinion. Not everyone shares this, but there's just so much embedded leverage in the system. But I think you and I are both skeptical of how much they can actually tighten. They want to show that they are going to, and build up the credibility and have some room for the next down cycle to ease again. But there's just not as much wiggle room at all. There's just so much leverage. Even our budget, has a huge amount riding on the interest rates that we pay. That's going to get bigger. Corporations are of course leveraged the most at any point in history, if you look at corporate debt to GDP. So we'll see how this plays out. But I think that is the second, third order effects that you and I are looking at down the road. And when we take a view of Bitcoin, it's that long-term view. And so on that, I continue to show this, again, not updated, with a few more percent down there, down to 40,000, but keeping that long-term price chart in mind of what this means. And I know we like to look at the 1 year, we like to look at daily charts, we look to look at weekly charts, inquiring minds want to know, but really as an investment thesis, you can't even really be looking at that unless you're talking about being more of a trader, which is not what we're talking about here.
Chris, I love the 200-week moving average. I don't know if we've talked about it on here before, right? But 200 weeks, right? 52 weeks in a year. So it's roughly every 4 years. looking backwards at price moving over time. So this is really slow moving average, and it's actually never gone down in its history. So over a 4-year period, the price of Bitcoin's never gone down. So the price of Bitcoin has never gone below the 200-week moving average, and it keeps just ticking up and up. And it's right around $20,000 now, right? And so I think of this as really a long-term, if Bitcoin's fundamentals are intact, then I would expect that to sort of hold, and it just keeps sort of ticking up because the price is always above it. And I thought it was interesting just to see this past week we were at 18, 19,000, pushing 20,000 on that sort of really long-term moving average that has acted as a base for Bitcoin. And that 200 weeks, you might say, well, that's arbitrary. But again, think of the halving cycle, long-term fundamentals, 4-year period of time, really nice and long period of time where we can start to measure out those improvements in the network, and it's never gone down. I think that's something to continue to watch if you want to just keep your sights set on, like, is this network still growing over the long term? Oh, okay, let me look at the 200-week moving average. Still going up.
Yeah, exactly. And we'll talk a little bit more about why there's this 4-year idea embedded in there. It's not just made out of thin air, but that's an excellent point. If you look at the lulls in the price, we've just kissed that 200-day or 200-week moving average, like you said, but it continues to climb slowly, and Bitcoin has never really gone below it. So again, when we get a big drop in price, the big question we want to ask is, does this change the investment thesis? And the only thing that would really change the investment thesis is if you see a change in fundamentals, not just price, right? Price is noise. We want to look at the value being created, the fundamentals driving the network. And so here's one that we like to look at: Bitcoin transactions and active addresses. Very noisy. So I've just put a 200-day moving average on this to smooth it out. And you can see the transactions have kind of dipped and leveled out, plateaued there in the green. And then the active addresses also dipped. You see a similar decline like you saw with the 2017 kind of blow off. So some people would say, well, maybe we did see, a cycle top for at least a year or more, who knows? And, the other way to look at this as well, we got an initial drop down, but it's already recovered yet. And that's why that moving average is, a little bit delayed, but you should see that smooth out as well. Have you been seeing anything on this side in terms of fundamentals or any other things to add here?
Yeah, nothing crazy. I would say that there's this trade-off of fees, because if fees are too high and there's a lot of people trying to use the base layer, well, then people complain that there's not enough throughput and it's too expensive to make transactions. And now today, I mean, you can look on any basic block explorer at the largest transactions taking place, and like people are moving like 500 million for $2.50.
Yeah.
And it's pretty crazy. But then people will say, well, then there's not enough demand, and maybe that's a sign because those transactions are so cheap. It's almost like you can't win with like transactions and base layer activity. We do want to see more and more activity and more address growth, definitely. But what I would say is too, it's important to look at scaling solutions being built on top of Bitcoin, that then all those transactions and all of that growth doesn't get accounted for on the base layer. And so we're seeing that with Lightning, of course. And what we're seeing there is more channel capacity, more opening of channels, which again is just sort of exactly what you would want to see in terms of fundamental growth.
Yep. Great point that this is just one snapshot and there's other things going on that are contributing to this as well. So the other thing I thought I would pull up, and I saw a few of these, bandied about end of the year as people kind of took stock of the Bitcoin network and the ecosystem. And I would call this kind of off-chain, like fundamentals that aren't captured in those on-chain metrics, but still we can look at for a growing interest. Because again, one of the biggest risks to this investment thesis is that this whole thing kind of just withers and fades, right? People are apathetic about it, or it doesn't do what it's supposed to do. And so a simple thing you could do is Bitcoin search terms. If you've never used Google Trends, the way it works is you take a period. So this is the past 5 years. This is worldwide, not just the United States. And it scales it to the highest point. So the highest point was that bull run in 2017. That was a largely retail-driven phenomena. So the highest point gets 100, and then everything else is scaled to that. And so in this past year, early 2021, we got to 75 a couple times. So 75% of the same level of interest. But what really stands out to me here is this wasn't just like that retail phenomenon where completely typical of a retail mania is this huge spike up as everyone is piling in. And then when the price collapsed, everyone piled out and everyone lost interest, right, for years. But instead, we got the spike up and it stayed around 50 to 75 for most of the first part of the year, first half of the year. And even though we're down, we're still at 25 and it's sustained. So I think we're seeing a broad interest across the world. And this is helped by, El Salvador and some other things we'll talk about. But again, I see this as very encouraging. It's not like past mania highs or cycles. The other thing you can look at is someone pointed out Google Scholar articles published. They ran a query on how many times the word Bitcoin is mentioned or how many articles have the word Bitcoin in it. It used to be dozens. Then it went to a few hundred. And the last 3 years, it's been over 20,000 scholarly articles per year. And I think this year they're still tabulating them as they came in, but this year is going to be a new all-time high there as well. And then finally, we just saw an incredible amount of money being poured into this ecosystem mostly from the VC side. So $25 billion in 2021, that's 700% over the last year. So dwarfing all previous years combined really in a number of ways. And, you can say maybe some of this is indicative of some euphoria or, overpaying in terms of some of this funding stuff or people just trying to, get into the latest VC fad as some of these things go. But at the same time, this is real money. It's being built, being used to build out this ecosystem in all kinds of ways, all different companies, all different tools and infrastructure around Bitcoin and digital assets. And that's what's going to have staying power. That's what's going to help this, get to the next level, the next phase of development. And so whenever people point to Tulip Mania or Beanie Babies, it's like, you don't have this around those very distinct things, right? How do you build out an ecosystem for Beanie Babies? Like maybe some people built some stores on eBay or something, but you don't see something like this. And so again, these are just other things that you can look at to make sure this investment thesis is still valid and it's still growing apart from what you're just seeing in terms of price action.
Yeah, I feel like the difference is night and day between like 2017 and whatever you want to call it, the past 2 years as being like this era of this Bitcoin halving, however you want to divide it up. But like 2017, it was quite clear that most people were just jumping on the bandwagon, hopping on just to, say they're involved in it and that this is like some interesting thing that's happening that they can make a quick buck doing. But I feel like nowadays, especially even people my age anecdotally are like really interested because they can see it now. They've done homework and they understand like what's going on here is like an actual shift in the way the financial system is structured over time, and that the building is going to not be 1 year and everybody fades and leaves the space, but like this is a multi-decade long shift in the way the financial system works, and people want to be a part of it and are excited about it.
Yeah, exactly. So we mentioned that 4-year halving cycle, and one of the questions that comes up is it delayed or dead? So on this chart here, what we've done is we've just taken the performance in percentage terms and scaled it to where the chart starts at the halving. So when that reward gets cut in half, we did not include the first few years of Bitcoin. So we only started at the first halving and then the second, and now we're in the third. And so you see we're about halfway, about 2 years into this. And obviously you can see we're far underperforming the past 2 cycles, right? And so the first one, 9,000%. The second one went up 3,000%. We went up about 500-600%. So it looks small. 500 or 600% is still nothing to scoff at over just a couple of years here. But it leads to questions. Some people say, was that just a product of the beginning? or is Bitcoin actually too big that we shouldn't expect, there's the same scale of returns, so kind of law of diminishing returns or law of large numbers, where something's just getting bigger that you don't have as much room to grow. Maybe Jack, just talk to why do we even talk in 4-year cycles? Like where does the theory of this all come from?
Yeah, well, the 4-year cycle, right, has to do with Bitcoin's halving cycle. So new Bitcoin are issued through the mining process, and every 10 minutes, roughly, there's a block mined, and new Bitcoin is issued per Bitcoin's issuance schedule. And what'll actually happen over time is less and less Bitcoin is issued on a 4-year basis. There's this adjustment. And so originally it started with 50 Bitcoin were released every single block that was mined. And then after roughly a 4-year period of time, that number got cut in half to 25, right? And that was the second sort of where we can see here is this gold first halving, right? That's measuring this sort of 2012 through 2016 price era. And then in 2016, 17, we had another halving event, and you can see this second halving era. Right? And this idea is that every 4 years, that the scarcity of Bitcoin is actually increasing. And so then there were sort of different models created, like the stock to flow model, which we've talked about and continue to, which was thinking of, well, why don't we measure Bitcoin based off of its supply issuance? And then every time it gets tighter, right, the supply gets tighter because there's less issuance measured by the existing stock relative to the new flow. Right, and that would get ratcheted up every 4 years on that halving event, and the idea would be then the valuation of Bitcoin should rise roughly every 4 years because it becomes more scarce. Now, in reality, right, that model should probably just be looked at as one input, right, which is a supply side model. And I think that when we pair that with maybe a demand side model of Metcalfe's law and certain other models of price to look at valuation, then we can start to come together at some sort of long-term pricing of Bitcoin. But yeah, that's the theory behind halvings and why there's this idea of like price being really bullish post-halving.
Yeah, and this is what's so unique about Bitcoin, that halving is a one-off event that takes place immediately. So it's triggered when at a certain block number, which is why we say approximately every 4 years, because approximately there's a block every 10 minutes. So we don't know the exact date until we get very, very close to it. But like clockwork, every 4 years, that gets cut in half, and it's immediate. It's like 1 minute, the miners are pulling in 25 per block, and the very next block, it's 12 and a half. Right. So it's a cliff. It doesn't dial down or kind of ease into that. All of a sudden, you're releasing only half as many Bitcoin. And so again, if the supply is inelastic, it doesn't change, and demand stays roughly the same, well, you take away half of your inflow of supply and demand stays the same, price has to adjust, right? And this is what makes Bitcoin unique, and especially unique compared to gold, right? Gold's supply could change with the price because it could induce people to bring out gold from their stores or their jewelry, or gold that's in the ground that was previously uneconomical at $1,500 an ounce is now economical at $2,000 an ounce, or whatever. And so this is one of the very unique things about it. So I don't know, Jack, if you want to give any not predictions, but your opinion on whether you think this is delayed, dead. What do you think?
Well, I think logic would presume that you would have to expect returns to decay over time, right? Any asset, like I hate when people will say, well, it's the best returning asset over the last decade or something. It's like, you could make that case of any asset that's born into existence with the price of zero, or whatever the first market price is. The market cap of $10 going to a market cap of $1 billion is an incredible return, right? But over time, as it pushes up against the bounds of just how much money is in existence, or how much, what's the value of all assets, you'd expect those returns to go down over time. I do think it's a bit surprising, that we didn't see sort of push over these all-time highs. And so now there's a lot of discussion around do we leave these halving cycles, these huge boom and bust cycles, which was sort of thought to be created from these halving cycles, and whether it was psychology of the halving cycles that created it or the actual halvings themselves, probably a little bit of a combination of both, right? Because even in 2020, there was a lot of hype around the May 2020 halving and what was going to happen to price, and people jumping on board because they became more aware of what this asset was as a result. So I think on net, it was like beneficial to start talking in terms of halvings and 4-year cycles. It probably got more participants into the network and to ask hard questions about like, what is money? What are monetary assets? But now as it, the asset gets more and more institutionalized, like today, every single halving that occurs, right? Today, there's 6.25 new Bitcoin minted every 10 minutes, right? The next halving, right, it gets even smaller and smaller. And so the impact that halving has on pricing is probably going to be less and less important. Like even exchange fees today make more than miners are making from newly minted Bitcoin. Right. And so then when you sort of back that out, you're like, well, are they liquidating that Bitcoin, right? That 0.5% of Bitcoin that creates that spread. Well, that's more sell pressure than miners minting new Bitcoin and putting new supply into the system. So I think that leaving this sort of 4-year epoch behind might make some sense going forward, where now instead of being less its own idiosyncratic thing, it becomes more sort of wound into broader macro and what's going on with the dollar and interest rates and things like that.
Yep. No, that makes sense to me. It was kind of on its own island. It was small enough that this really affected it. Now it's playing on a much bigger stage. So like you said, it's going to be affected by all these other factors. All right, so let's move on here. This was a chart we showed last time, so we thought we would just be transparent and give an update here. Bitcoin price versus the free float MVRV, which is the market value to realized value. So it's market cap divided by the realized market cap, which is instead of taking all Bitcoin and multiplying it by the current price, you multiply each coin at the last price it was moved or traded. So it's kind of like an overall cost basis, if you will, but with the caveat that just because it moves doesn't mean someone bought or sold it. It could just be an internal transfer for someone. But nevertheless, it's still a pretty good indicator in terms of you see spikes in MVRV when we get kind of a blow off top, a cycle high, and then historically a ratio of 1 or below 1 is a generational or great buying opportunity generation in terms of the lifespan of Bitcoin itself, not in terms of a human generation, but it still remains ambiguous here. It's not, way up there, but it's certainly not at 1 or below. So again, we thought we would just call it like we see it, which is it's could kind of go either way here. And again, getting back to the discussion on 4-year cycles, this time is different. There's a little different wrinkle here. We didn't think it could be that easy, right, Jack? Where it just plays out exactly like the past 2 or 3. So
yeah, and that chart I think also speaks to like, nothing about this $40,000 price is like thin air, right? We're going right back down to $10,000 for sure, right? Because it's more reasonable where we're trading today than where we were, earlier this year, right? Or earlier last year.
Yeah, 2021. Yeah. All right, Jack, I'll pass it to you to give an update on the futures market as well, something you talked at length about last time.
Yeah, so I won't give too much of a rundown of like the makeup of the futures market. We did write about it in the December newsletter. If you missed sort of our chat recapping last discussion, but the Bitcoin futures market is really driven by offshore perpetual futures contracts, so non-expiring contracts. And then there's this interest rate that's paid based off of if more people want to go long or more people want to go short to keep the derivative trading at the spot price. Too many longs means the longs will start to pay the shorts, and too many shorts means the shorts will start to pay the longs. The funding rates currently are pretty neutral, and so I didn't think it was that important. They haven't really shifted since we talked last time, but I thought this chart of collateral makeup was quite interesting to see this shift. So last time we had talked, we were sort of back November into December, this was right after some liquidations and a sell-off in the price of Bitcoin. And the makeup of the collateral that was backing the derivatives market was roughly equal. So roughly half the people that have levered longs and shorts were collateralizing in stable coins, and roughly half of them were collateralizing in Bitcoin, right? And we know that the trade profile of a perpetual futures that's levered, right, is more susceptible to being liquidated. If you're levered long and you have coins as your collateral, you're more susceptible. It's a more risky trade. You're more susceptible to being liquidated versus if you have stable coins as your margin or as your collateral. And the opposite is true for people that are shorting, right? So if they have stable coins as their collateral, it's a more risky trade, right? Because if the price of Bitcoin goes down, right, you're losing that trade and you have a stable asset versus, if the price of Bitcoin goes up and you're short, right, then your position is losing value and you don't have Bitcoin that's covering it, right? And so what we've seen over the past month or so is an increase in stable coins as the collateral of choice in this derivatives market, which necessarily just leaves the market a little bit lopsided in terms of shorts sort of swimming naked somewhat, rather than longs sort of swimming naked. And now what have we seen, right? Downward price pressure and liquidated longs. But the market's sort of churning underneath in this derivatives market. And it's sort of like everything's been flushed out on the long side. So can the price of Bitcoin continue to go down? Sure, but it's not necessarily going to be driven by the derivatives market. All of that to say, right, is sort of a lot of the levered longs have been flushed out. And now from a funding rates perspective, from a collateral makeup perspective, those longs are definitely on much more solid footing than they were. They were on more solid footing a month ago than they were at the beginning of the year, right? At the beginning of the year, funding rates were high and everybody was using Bitcoin as their collateral, which is sort of a recipe for disaster for leveraged longs. And now sort of the opposite is the case. Funding rates are really low or negative, and a lot of the collateral makeup is stable coins. And so you have sort of the opposite effect. So I would say spot market is sort of going to be driving price over the next month or two. And a lot of what's driving the spot market is probably what's going on in the macro picture.
Yeah, I agree. I think that makes sense. Like you mentioned, I was just looking at the perpetuals. They're slightly positive, but pretty neutral, which is different from what we saw before. So probably a lot more spot driven, and macro is certainly taking over again today as well.
Yeah, definitely.
All right, so we'll go through a couple of the things we talked about now in the newsletter, because there have been a few updates since we wrote the letter that we can expand on. So China, huge story, 2021, as we mentioned, maybe kind of setting off an initial sell-off with the mining ban. And then, as we mentioned, we just saw a wonderful way this network just kind of organically reconstituted itself. It spread to different parts of the world. These miners packed up and moved, came back online, hash rate at all-time highs again. We did get a little hit with Kazakhstan. A lot of the miners went to Kazakhstan because it was fairly close to China and cheap power. But now with their kind of revolution going on, the government shut off the internet, so that knocked out a lot of the hash power there. But something we continue to see recover as well. And so I think what's really topped this story for me was last week I saw headlines that they are actually rolling out a trial version of their digital yuan wallet. So again, this was long speculated as the plan, and you could see a lot of signs of it already. So probably not at all a surprise. But I think it just confirms for all of us that Occam's razor, the simplest explanation to what China was doing with Bitcoin, made the most sense. There was all these rumors, if you remember, of when they had a ton of mining power in the country, that they could do a state-sponsored attack. They could take over the miners. They could attack the network, and then had all kinds of nefarious plans. And I think to me, I could be wrong, but it seems like the simplest explanation was nope. They first wanted to really get rid of it, quash it out, and then roll out their own their own digital currency that they could control. They obviously realized right away that they couldn't control Bitcoin. This is one they can control, not only the supply of it, but they can also easily build this into, for example, their social credit system. Anything that you've seen in China, Jack, or is this really just kind of what you expected as well?
Yeah, I think all those points are great. Probably too off topic to get into, but like more and more, we've just seen China wanting to de-dollarize, right? So they stopped buying treasuries, I don't know, 3 or 4 years ago, right? And what we've seen is them try to price energy in yuan convertible for gold. And so there's sort of this geopolitical battle going on of like, countries that are enemies of the United States or are trying to move off of the dollar, and this is China's sort of big push here is to and you want to get all of these private cryptos out of the way, so you ban them first, you cut out the mining, and then you say everybody has to use this digital yuan. I think that it'll be interesting to see what happens with the digital yuan and this whole rollout. And then, what does that imply for places like the US and Europe and Japan in terms of, do they go CBDC route? Do we regulate the stablecoin market that's evolving? I don't know, but maybe in 6 months, we'll see what's going on in China and what that might imply for how the US reacts.
Yeah, great point. And I did see too a few reports that there is still a fair amount of mining, probably more than I would have expected, that stayed and just is operating underground. And I think I saw someone commentate and they said, Bitcoin finds a way. I don't know if it was Michael Saylor or someone who said that, obviously in reference to Jurassic Park, nature finds a way. And so I just love how we've seen through this whole year, this organic kind of system finding a way to reconstitute itself and still continue to operate. El Salvador, on the other end of the spectrum, of course, is this country completely embracing Bitcoin, making it legal tender. Most recently, the update here is I saw, according to Reuters, that the government has advanced some 20 odd pieces of legislation in their government that are supposed to kind of pave the way for this Bitcoin bond. So El Salvador wants to sell $1 billion worth of bonds. Half of the money will go to buy Bitcoin itself, just adding it to its treasury, which they then plan to sell off and repay some of the bond in a few years, provided Bitcoin goes up in terms of dollars. And the other half will be used for infrastructure. Excuse me. So they have this, idea of Bitcoin City. I'm not exactly sure what to make of this, all of this, because it's a lot of announcements. Even the Bitcoin bond was a PowerPoint. I don't think we've seen like a real term sheet. Not to say that this isn't real or anything, but the devil's going to be in the details of how they get this through. And I guess 2022 is just going to really show kind of which way of the two extremes, and not to over generalize, but just for simplicity's sake, there's those that think they look at Bukele, the president, and they say, he's a megalomaniac. He's, got some questionable human rights stuff behind him under his leadership. This is just a big ploy for him to somehow advance his own agenda and his own power. And on the other end of the spectrum, again, just to be extreme, to show the point, is no, he's the real deal. Like, they're all in. This is going to be amazing. El Salvador is going to rise as like the next great Bitcoin country in the world, right?
Yeah, to your point, it's binary. Either way, this is front page of the newspaper. It's just, is it going to work out really well, or is it going to look really poorly?
Yeah, I think the structure is certainly going to lend itself to be kind of binary, but it's probably going to be a little bit in between those two extremes. I will say that on the side of this is a little more legitimate, or at least why I give a little more credence, is that they chose Bitcoin as the cryptocurrency, if you want to say that, to launch this project, not some other token or inventing their own token. So for example, I don't know if you remember, Venezuela started the Petro, which was supposed to be a digital currency backed by their oil and their mineral reserves. Well, of course, everyone knew this was just a farce because it was centrally controlled by an actual dictator. And there was just no assurance of how you would ever redeem this thing for oil. So you could say, yeah, it's backed by oil, but who gets to redeem it, right? And of course, the thing was a big failure. So I think what is notable to me is that they chose Bitcoin, one they can't control, one that is truly autonomous outside of El Salvador or any other nation for that matter. And then one last thing we'll touch on here is, Bitcoin developer activity. We've gotten some questions. There's been two pretty notable Bitcoin developers that said they're leaving Bitcoin projects to work on other things. This is some data we have on the right, tracked by our platform called Sherlock. It gets it from GitHub, but it's the number of Bitcoin active developers. And you can see a bit of a decline. On the other hand, I did see a recent report, 2021 Electric Capital Development Report, where it looks like they look out over a wider code repository base. And that report said they've seen a 9% increase in Bitcoin developers in 2021 over the last year. So maybe two conflicting data points. But overall, I would just say, there's two views here. Number one is this is a concern. People are leaving. You need to have developers to continue to increase the development on Bitcoin and do those Bitcoin improvement proposals. But on the other hand, the opposing view could say well, what's the ideal number of developers? Maybe now that Bitcoin's a lot more mature, maybe it doesn't need as many developers. And you don't want people tinkering with it just for the sake of tinkering with it, right? I mean, these improvements need to make sense. They need to actually provide value. So maybe Bitcoin is best left alone. Maybe it's not such a bad thing that it's going to kind of just be Bitcoin, which is what a lot of people point to in the first place. I don't know if you had any thoughts on that as well, Jack.
No, I think you make the case for sort of both views quite well, where it's like Bitcoin is like heart surgery. It's like operating on a nuclear reactor, where if one thing goes wrong, well, then everything that you put together, which was this idea of there's only 21 million, everyone has the same user rights, and let's make this as decentralized as possible. Like, it's trying to fill that monetary role. The second that you exploit it, or there was a bug in the protocol, the second all of the value prop goes away. And so it's not necessarily a bad thing that there's less people tinkering with it. If the number was dropping to zero, I mean, there's probably a concern there, but developer activity on Bitcoin, where it's not really competing for adding new, whiz-bang features versus Ethereum and Solana competing against each other, developer count definitely matters for assets like those. With Bitcoin, not so much.
Yeah, exactly. Good point. And then mining, we talked about Kazakhstan a little bit, and then I just saw Marathon, which we've pointed out before, raising a lot of money with a convertible bond that got upsized. They started at 500 million, upsized to 650 million. We have seen them put in a purchase now, 900 million machines that will be delivered over the first half of this year. And then Hut 8, I just saw a press release from them a little while ago. They were mining an average of 8.9 Bitcoin per day in December, and they've been holding all of those Bitcoin as well. So again, just more bullishness from the miners as well. All right, so let's get to the Q&A here. I've got a couple questions that came in. First one, how will the price of Bitcoin get affected by Congress and regulation? Any thoughts there, Jeff?
I think Bitcoin, this is one of those spots where you have to separate Bitcoin from all other digital assets, right? And I think it's far less of a threat for Bitcoin, where we sort of know it is, from the get-go, it was a decentralized protocol, right? That didn't have a pre-mine, it doesn't look like an equity security where a lot of the other digital assets do. They look like unregistered securities, which then brings up this idea of you really have to regulate it to put it on a fair playing field with traditional assets anyways. And I think with Bitcoin, I see it as a positive. We keep writing about this idea of a reflexive loop of of regulation coming, allowing products and services to be built. And you're always going to have crypto native firms that necessarily, like, they don't have a traditional business that could, if they get in regulatory trouble, that they're putting in trouble, right? So it's always going to be crypto native firms with less to lose that push the bounds, and then regulators have to come in and regulate. And then traditional financial services firms that they manage a lot of the capital are then able to put products and services in place once they know that regulators have given them the green light. And then once all of those sort of combine together, the regulators plus the traditional financial firms and crypto firms working together, that allows all the capital to become more comfortable and flow into the space. And I think that long term, it is a net benefit to the industry as a whole. Might be more of a headwind to non-Bitcoin digital assets whenever some sort of regulation comes. But it does seem like there's still a lot of feet dragging going on in terms of actually just putting something forward, because it's so complex. Do we make a new regulatory agency? What sits under the CFTC? What sits under the SEC? Nobody really has a good answer, and it doesn't seem like many are willing to stick their neck out and make that decision. Thus far, it's been kick the can down the road and we'll figure it out.
Yeah.
Maybe intentionally.
Yeah.
What do you think, Chris?
Excuse me, got a tickle here, but I agree with you. The catch-22, we saw SEC Chairman Gary Gensler put out his agenda, and it doesn't really have anything with digital assets on it. And then we saw fellow chairperson Hester Peirce and another one write an open letter expressing their disappointment in this. So clearly there's some people there that want to get this done, that want to tackle it. But like you said, some strange feet dragging as well going on. So hopefully we get some movement there into 2022 here.
Definitely.
And then one more question here. Can you comment on the Mt. Gox distributions that is unlocking a significant amount of Bitcoin that was previously unable to be moved? So for those who don't remember this, Mt. Gox was one of the very first Bitcoin exchanges. Funny name, you say, why Mt. Gox? It was a repurposed exchange that was called Magic the Gathering Online Exchange. And Magic the Gathering is a collectible card game that a lot of people play. And so they would use this exchange to trade these cards, these trading cards. So they took that technology, they turned into a Bitcoin exchange. It became one of the largest exchanges back in the day, handling over 90% of the volume. It was based in Japan. And I think, there's, of course, we won't comment, but there was just kind of a lot of debate over Mark Karpelès, the person who was handling this, whether he was just kind of incompetent and lost a lot of the Bitcoin, or there was some malfeasance going on. We'll leave that aside. But what's happened now is they were able to recover some of the Bitcoin that were lost. I think it was like 850,000 originally lost, and I'd have to check, but it's somewhere around 140,000 that they recovered.
Yeah, 140.
Yeah, 141 maybe. And so people who have claims will be able to get some of those back. They're going to distribute some of those to the creditors. And so the question is, when these become distributed, what are people going to do? Are they going to go out and just sell them all? Because obviously they're worth way more today, sitting locked up for years, than they were back then. I was just doing some quick back of the envelope calculation. If 900 Bitcoin are created every day and released to the miners, 141,000, that's about 157 days worth of new Bitcoin that will become unlocked. My personal opinion of this is it could create a little selling pressure, especially initially. But overall, this is just going to be changing of hands again, to people who want to recognize some liquidity, to those who want to hold it. And also, I guess I just have to think, if someone was invested enough in Bitcoin that early, that they were that ahead of the curve in buying Bitcoin from Mt. Gox, they're probably going to be the type of person that would still want to hold it today. I don't know. What do you think, Jack?
Yeah, you stole the words out of my mouth there. That was going to be my hot take. Is that, when was that? 2015, Chris, right? When that occurred. And so happened in 2015. If you were involved in Bitcoin in 2015, I think that maybe you understood things before other people did. And So what is that in total? 141,000 Bitcoin is 5 to 6 billion. You start breaking down the numbers, and I think you can make a case easily that 50+% of those Bitcoin aren't actually sold. And so now you're down to 2 or 3 billion, right? The number gets smaller. And I don't think that it's actually getting released. Like, I think the news broke the end of the year that it was, this Bitcoin is coming, but I don't think it's actually getting released anytime soon. It's probably going to be another 6 or 12 months for that. So something definitely to watch. And I think a great point to point out, but I don't know if it's a huge concern. Maybe a short term, at some point when that unlock happens, maybe there's a short term panic in the market. But
yeah, I think there will be, a little blip, but and again, this is just our opinion, our speculation, but not a huge earth-shattering thing here. So that's all the questions we have in the queue. So if anyone else has any questions, please type them in now. Otherwise, I think we are coming close to the end of the hour here. I'd like to thank everyone for joining. Please do keep an eye out for our monthly newsletter. We've got some more reports slated, one for January, so keep an eye out for that. And then, of course, if you haven't already, visit our blog, and you can find all of our research at fidelitydigitalassets.com. Thank you.